Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of corporate filings so you don't have to. Today, we're diving into Navient Corporation's annual report. And let me tell you, after reading this, you might feel like you need a student loan just to understand it all, but don't worry, we'll explain everything in simple terms. Navient, at its core, is in the business of education finance. They help people manage student loans and navigate the whole paying for college maze. They've got a big chunk of both federal and private student loans. But what's been happening recently is Navient is simplifying what they do, trying to be more flexible and cut costs. This report really tells the story of that shift. One of the biggest moves Navient made was deciding to outsource their student loan servicing. Think of it like this: instead of handling all the customer service and billing themselves, they hired another company, MOHELA, to do it. This outsourcing deal, which started in the middle of last year, is a major shift. Almost 900 Navient employees moved over to MOHELA. Navient is betting this will save them money long-term, creating what they call a variable cost structure. They also went on a selling spree. They sold off their healthcare business last year for a nice chunk of change, almost $370 million. Navient also sold its government services, simplifying the company. Because they're smaller now, they are reshaping their internal workings to make sure that internal footprint matches the streamlined company goals. Let's break down how Navient makes money and what's happening in each part of their business. First up, federal student loans. Navient owns and manages a portfolio of these loans, and they make money on the interest. However, this portfolio is shrinking because the federal government stopped making these types of loans a while ago. So, they're focused on helping people pay off their loans while maximizing what they earn from this existing portfolio. Next, we have their consumer lending segment, which are private student loans. Navient not only manages these loans, but they also originate new ones through their Earnest brand. Their focus here is to help students and families plan and pay for college. Finally, the business processing segment, but now this part of the story is over. Navient used to offer services to government and healthcare clients, such as contact centers and revenue management. As mentioned before, they sold off this whole segment in several transactions. Looking at the financials, Navient's report shows the net income decreased. Net income for the past year was $131 million. A year before, it was $228 million. This all boils down to some pretty major changes in the company. One of the reasons for the decline was fewer assets from the loan portfolio because the FFELP loan payments increased. There was a gain on sale of healthcare services business and the sale of government services. But they also had some higher private education loan provision for loan losses and restructuring expenses associated with all the big changes they're making. All this combines to make 2024 a more difficult year in terms of net income compared to 2023. Now, even with that dip in profit, Navient returned a lot of capital to shareholders. The company repurchased $179 million of its own stock and paid $70 million in dividends. They were using their balance sheet to make value. To get a sense of capital allocation, we need to see something called adjusted tangible equity ratio. This is a metric Navient uses to inform its capital allocation decisions. Their GAAP equity to asset ratio was 5.1%, and their adjusted tangible equity ratio was 10.0% as of December 31, 2024. Of course, no corporate story would be complete without a discussion of the risk factors. These are the things that could throw a wrench into Navient's plans. There is a whole section with items like general economic conditions, interest rates, government regulations. But one that stands out is data security because Navient handles a ton of sensitive customer data. A major data breach could have all sorts of bad consequences. There was something called government services goodwill impairment, which basically means they had to write down the value of some of the companies they owned in their government services business. This happened due to the loss of a key contract. So what's the overall takeaway here? Navient is a company in transition. They are actively reshaping their business by cutting costs, outsourcing key functions, and focusing on their core lending activities. After reviewing the report, some strengths and weaknesses in the numbers can be seen in the numbers. On the one hand, Navient is making big moves to become a simpler, more efficient company, which can have a lot of potential. On the other hand, economic and regulatory uncertainty could make the journey tougher. The student loan market is always subject to political changes. For instance, any further changes by the Biden administration could really shake things up. Navient is still dealing with the risks of handling private student loans, along with handling more regulation. Overall, Navient has some challenges ahead, but it is actively working to reshape its business. How well they execute this transformation over the next few years will determine their long-term success. Thanks for watching. If you enjoyed, please subscribe, like, and comment.